Hello and welcome to today's lesson. I'm your hard-working but indefatigable teacher, Mr. Burton. You will need to watch this video and take notes as you go. You may need to watch certain parts of the video a few times to ensure complete understanding. This is your homework and I will check your notes tomorrow before we get started. I hope you learned something. Okay, hello and welcome to today's lesson. Today we start with our second type of balance day adjustment, depreciation. So today the things we want you to pick up. Explain why property, plant and equipment must be depreciated. We want to state the definition for depreciation, and then we're going to state the journal entry required to record the depreciation. After that, we're going to move on into how to depreciate.
Depreciation indicates how much an asset's value has been used up. It also tries to match the expense of an asset to the income that the asset helps the company earn. Used as an income tax deduction, depreciation calculations offer businesses an annual allowance for the use and deterioration of tangible assets. Tangible assets are those that have a physical form, such as machinery, equipment, and buildings. For example, Dave's print shop buys a piece of equipment for $500,000 and expects it to have a useful life of 5 years. It will be depreciated over 5 years. Every accounting year, the company will expense $100,000, which will be matched with the money that the equipment helps to make each year. This is called a straight-line depreciation. The asset stops being depreciable when its cost has been fully recovered, or when it is taken out of service. Whichever happens first depends on the business.
So our definition for depreciation: the systematic allocation of the depreciable amount of an asset over its useful life.
An asset is a resource with an economic value. Individuals, corporations, and countries expect the assets they own to provide economic benefits now and in the future. Assets can be tangible, such as equipment and land, or intangible, including things like a brand, a chemical formula, or property rights. Assets are vital to a firm's success because they increase its value and provide the means to generate cash flow. They're important to an individual because assets, such as a bank account, a home, or a car, are necessary to satisfy daily needs. And assets are of great interest to investors who want to know what a firm owns and what it owes. Companies list assets they own on their balance sheets. A firm's total assets will equal its liabilities plus equity. Current assets are those that will be consumed within a year, including items such as cash, accounts receivable, and inventory. Fixed assets, including equipment and buildings, are expected to provide benefits beyond a year.
Okay, so we've been through our definition of an asset before. Now depreciation is all about those tangible assets because assets lose their value over time. Typically lose their value over time. Property, plant and equipment. Why does a business buy property, plant and equipment? The only reason is to help the business produce goods and services to earn an income. How long is property, plant and equipment kept for? More than one accounting period, so longer than 12 months. Now what's going to happen to the ability of property, plant and equipment to earn an income over time? As the asset deteriorates, that ability to earn an income over time is going to get worse. Now it's going to be harder for PPE to produce goods and services to earn an income. But why? The older PP and E gets, the worse the wear and tear, and eventually the asset's going to become obsolete. So think of a computer A computer made 10 years ago is going to be practically useless today. It'll be obsolete. Now, recording depreciation recognizes that the future economic benefit is going to be used up. Depreciation can be considered as a measure of the use of those economic benefits contained within the asset in each period the business has that asset for. Key terms that you need to know. The depreciable amount is equal to the cost less the residual value. Cost is the initial purchase price. Residual value is the estimated value of the asset. Residual value, the estimated amount that could be received if the asset is sold, subtracting away the cost of disposal. The useful life of an asset, this is a period over which an asset is expected to be used by the business. So, for example, that computer may have a useful life of 3 years, whereas an office desk may have a useful life of 6 to 10 years. Different assets are going to have a different length of useful life. The carrying amount, this is cost less accumulated depreciation. So the cost of the asset and subtracting how much it's been depreciated. Right, depreciation, asset, debit, expense, and we're going to credit the accumulated depreciation of that asset, and this is a negative asset. So here we've got the general journal, year 1, depreciation on a van, delivery van, no doubt. It's an administrative expense. So depreciation on the asset, accumulated depreciation on the asset. We name the asset, and in this case it's van, so we'll credit negative asset. So it's on the left hand side of our accounting equation, but it's a negative asset. And our narration, year 1 van depreciation of $4,000. Right, we've got 2 methods to depreciate our assets, and the first we're going to look at is straight line depreciation. So just quickly, now we need to be able to calculate the depreciation using the straight line method. We need to be able to prepare a depreciation schedule. Then we need to prepare the journal entries for the straight line depreciation. And finally, to be able to prepare extracts for our financial statements, our income statements and our balance sheet. Right, straight line depreciation, the depreciation method results in the same equal amount of depreciation expense for each full year over the life of the asset. And when is this method best used? When the expected benefit from an asset is going to be similar in each year of its useful life, and that's because straight line depreciation calculates the same amount of depreciation each year. So for example, a computer or a car is going to lose a lot of its value in the first year, first 2 years, first few years. It might not make sense to do straight line depreciation in that instance. Whereas office furniture, say a desk, is going to depreciate. It's not going to lose much of its value in over that first few years. It's going to be equal, similar in each year of its useful life. So the value of an asset, we've got the value of an asset up the y-axis, and across the bottom there on the x-axis we've got number of years. So the value of the asset is going to steadily depreciate by the same amount. In this case it looks like $10,000 each year. Straight line, if we graph that, our formula, cost less residual value, which is estimated, divided by the estimated useful life, which again is estimated. So the accountant is going to make a guess at how much that asset's going to be worth, and how long the business will be using it for. So for example, a car is purchased for $20,000 excluding GST. It has an estimated useful life of 5 years, and after that 5 years it's expected or estimated that the business will be able to sell it for $5,000. What is the depreciation expense per year? Easy. $20,000 is the cost, $5,000 is the residual value, we subtract that out and we divide it by the estimated useful life. $3,000 per year. Let's have a look at a worked example now. Another vehicle, this time a delivery van. The cost is $35,000 excluding GST, and it's expected to last 8 years. And when it's sold at the end of 8 years, it's expected to be sold for $3,000. Calculating the amount of depreciation for each year, we've got our formula: cost less residual value divided by the estimated useful life. Cost being $35,000, residual value $3,000, and the estimated useful life of 8 years gives you $4,000 per year. So a key figure. Once we've got that, we can go to something we call a depreciation schedule, and this is exactly what it looks like. Year, cost, carrying amount, opening, depreciation expense, accumulated depreciation, so that's year on year, and the carrying amount or the closing amount. In year 1, cost 35, depreciation 4, accumulated depreciation can only be 4,000. We've got cost 35,000 less depreciation, giving us the carrying amount and the closing of $31,000 there. In year 2, cost doesn't change. The carrying amount is transferred from the carrying amount closing the year previous, that was $31,000. Depreciation straight line stays at $4,000. Now we've got 2 years of that, so it's $8,000. $35,000 less $8,000 gives us $27,000. That $27,000 carrying amount closing transfers to the carrying amount opening of the next year, and the pattern repeats itself. Now, our journal entries. Depreciation expense for year 1. Depreciation on van 4,000. Accumulated depreciation on van with the note. Year 1 van depreciation $4,000. Super simple. The notes on the income statement. Well, the income statement, which will involve a note, as we'll see. Now these are coming under distribution costs in this instance because it's a delivery van. Remember, distribution costs are an exception to our main type of expense, which is administrative expense. Anyway, so here we are. Because it's a delivery van, we're coming under distribution costs, so the depreciation costs fall into this category here. Depreciation on delivery van, $4,000. That's in the first year. The financial statement of financial position, our balance sheet. We're going to prepare a note for property, plant and equipment. So the opening carry amount, delivery van $35,000, depreciation $4,000, closing carrying amount of $31,000. Then we've got the cost price, accumulated depreciation, and the carrying amount. So in the first year, those two parts of our balance sheet extract look exactly the same. This will change as the life of the asset continues. So now we're going to go to the balance sheet and fill in the carrying amount. Non-current assets, property, plant and equipment, 31,000 with our note. Now we're going to go to year 2. Try this yourself. The depreciation expense is going to be the same, but when you prepare the note, the top half and the bottom half are going to be different. Let's have a look. Year 2, that depreciation stays the same, so it's accumulated depreciation of van will stay the same. This time the only thing different with the narration is that it's year 2 van depreciation. Income statement, nothing different there. The balance sheet, things do change within the note. So the opening carrying amount is not $35,000 anymore, it's $31,000, which it was at the end of year 1. Depreciation again of $4,000, giving us a closing carrying amount of $27,000. So now we had the cost price of the van of $35,000, the accumulated depreciation year on year for those 2 years, year 1, year 2, it's $8,000. So the carrying amount, or the value of the van on our books at the present period of time, $27,000. Go to the balance sheet, fill in the carrying amount, non-current assets, PPE, with our note, our van, which is now valued at $27,000. So, step by step by step, after initially calculating how much we're going to depreciate that asset by each year, straight line. Now, straight line depreciation can also be calculated as a percentage of the cost price. So in this example, the activity balance, the trial balance shows buildings with the cost of $100,000 and the firm depreciates buildings at 2% per year, each and every year. So here we have our depreciation schedule. Cost $100,000 in that first year, carrying amount opening, depreciation of $2,000. Just because it's the first year, accumulated depreciation must be $2,000 as well, giving us the carrying amount, the actual value, closing value at the end of the year of $98,000. Closing amount, carrying amount, closing transferred to carrying amount opening, depreciation expense $2,000 again. You can see it's straight line. The firm's depreciation buildings at a 2% per annum, and it's off that initial cost price. So it's always going to be $2,000 as long as it's straight line depreciation. Nothing different there. So we go through and everything's exactly the same. Depreciation on the building, accumulated depreciation on the building is our credit. Narration. Income statement, it's an AE this time. Administration expense. Depreciation of building, $2,000. So our balance sheet, preparing that note, and I think we're in year 4 still. Yes, we are. So the top and the bottom are going to look different. the cost price of the buildings, accumulated depreciation is $8,000 because we're in year 4. So 2,000 in the first year, 2,000 in the second year, 2,000 in the third year, 2,000 in this fourth year, giving a total accumulated depreciation of $8,000 and a carrying amount at the end of year 4 of $92,000. That's how much our van will be worth at the end of the year and at the start of the next period. Balance sheet and fill in the carrying amount. This is simple. Non-current asset, property, plant and equipment. A note there. And the value of our building is $92,000, assuming that's our only PPE.